it's very important to recognize that if you can develop a distinctive competency in managing risk, it can do two things for you. Obviously make you more competitive, but also increase the value of your enterprise. And we are passionate about helping our clients do that.
Welcome to our middle market moment, where we speak with other professionals who help business owners build value, de-risk their companies, and prepare both personally and professionally to do the deal of a lifetime through M&A. Today, I want to welcome Seth Shapiro of USI. Seth is Executive VP and Risk Strategist at USI, and he helps his clients develop and execute a cohesive risk management strategy consistent with their culture, mission, and objectives. Now, USI is a leading national insurance brokerage and consulting firm, delivering customized commercial insurance, employee benefits, personal risk, and retirement solutions to clients across the United States. Hi, Seth. Good to see you. This is twice today we saw each other, so great
It
to
is.
see you.
We've hit the limit for one day.
That's right. That's right. Well, welcome. And I know our audience is going to be appreciative of your insights relative to, risk and mitigating risk. And I'll kind of tee it off a little bit here, or tee it up as it were. They say that there's two elements of value: that which you create in your privately held company, and typically that's expressed in earnings and revenue and kind of your team, the team that you developed. And then ultimately, the second equation of value is how de-risked or how likely are those EBITDA, revenue, team engagement, going to continue, and or whether something can upset that apple cart and really destroy the value that you've built from a risk element. So having looked at both sides of those, we're spending a little bit more time talking about risk, obviously, today. So tell me a little bit as to how you personally and your firm kind of help people evaluate risk management and what that process looks like for you.
Sure, I'd be happy to do that. So I've been involved with the risk field since 1982, which is a long time ago. And I've also had some experience with the academic side of it. I helped start the risk management program at Seattle University a number of years ago and taught risk management for the first three semesters. And then I also have taught information assurance, which is a form of risk management at the University of Washington, for a number of years. And the experience both on the business side as well as the academic side has taught me that risk management is very challenging. And part of that is a function of the way that the human brain is wired. The example that I give is, there are people that will smoke, but that are afraid to fly. And you say, well, that seems illogical. And the reason why it exists is that the consequence of the smoking is way out in the future. Mm-hmm. And human beings tend to overly discount the impact of something that happens way out in the future, and they probably evaluate the risk of something that would happen today, like something happening in an airplane. And the same is true when you're dealing with business risk. Oftentimes, because of the world we live in, where big, hairy, ugly risk events just don't happen very often, it's easy to fall into a sense of complacency about just how likely they really are. I like to say that if these kinds of events happen even twice as often as they do, we probably wouldn't have an insurance industry. I'm not sure we'd have any industry, to tell you the truth. But the key thing to remember is that risk has a cost associated with it. And so, we're going to get into this topic a little bit later about, how do you maximize the value of your enterprise? You've got to look at it from a risk-adjusted perspective, because that's certainly how a buyer is going to look at it. Mm-hmm. There's a reason why you earn more on a, junk bond than you do on a T-bill, because it's a risk. You've got to be compensated for the risk that you're taking. Mm-hmm. And the same is true in just about every aspect of running and managing a business. If you don't explicitly consider the cost of risk in pricing your product and establishing your budgets, setting your key performance indicators, you're probably not doing it in a way that's correct. And, again, will it come back to bite you frequently? not frequently. But if the goal is optimality, it's really, really important to spend the time and think about, what are the exposures we face? How frequently will they occur? What's the severity? What's our risk tolerance? What kind of assets do we have to protect us? What kind of other buffers do we have? What other tools are at our disposal? Insurance is an obvious one because it's very readily available, but there are non-insurance contracts, there's policies, procedures, standards, and guidelines, there's compliance incentives, there's deterrence, there's building in resilience. I mean, there's so many different tools that you can use. And I like this idea, and it actually is talked about more in the information risk context of defense in depth, is how can you line up a number of different mechanisms for controlling, managing, shaping risk so that it's unlikely that a existential risk is actually going to manifest itself and either conceivably put you out of business, but more likely just result in really, really poor financial results or operational results for a certain period of time in which the event took place.
Yeah, I love that analogy, and I didn't think of it this way, but the smoking versus airplane. When people go to sell their business, it is a typically it's a time bound thing for many sellers,
Mm-hmm.
and the risk goes up exponentially, right? Especially if you're, let's not to pick on a number. I've seen,
Mm-hmm.
you know, wonderful 80-year-old business owners, but let's say you're 70 and you go to sell your business. Um, you really have to readjust your lens through which you're looking at risk, because number one is, will a risk event preclude me from getting to an exit
Mm-hmm.
and really take our certainty of close out the window? Because that's the first objective, is to get to a closing. The second objective is to get to a good deal. And the third objective is to get to a great deal, right?
Mm-hmm.
And all of those things can be affected by risk. So really the acuity, while I know a lot of entrepreneurs listening to this are going to go, oh, geez, risk. And yeah, I got to get more coverage. And, it's sometimes the last thing they think about. But when I look at the intensity and the actual risk of having a failed deal because you have, inadequate coverage, or you haven't assessed the risk, properly, that's huge. That's huge.
It is. And the way I look at it is not so much do I have coverage, is am I taking the right risks? If you have a distinctive competency for assessing, measuring, managing a particular type of risk, and you take that risk in your business, you can create competitive advantage. If you don't have that distinctive competency and you assume that risk, you could be putting yourself in great peril. So it's not necessarily having coverage; it's having the philosophy around understanding what you're good at,
Mm-hmm.
understanding the character of the risks that you face, understanding the rewards that you can uh, realize by taking those risks. I like this expression: "Don't risk a dollar for a dime." And
Mm-hmm.
oftentimes we find ourselves doing that, either as a function of expediency or because we just don't understand the dynamic. And it's dangerous. But again, we're lucky that we live in a world where the big hairy risks don't happen very often, but we know they happen. I mean, just look at the data. Companies that are, uh, this is a little bit apocryphal, but there's been a statistic that's been bandied about for probably 50 years, that a company that suffers a significant casualty event, fire burns down their factory or something like that, 70% of them are out of business within 3 years. No one can find the source of that, but it seems reasonably logical um, to me. And I can explain why, but that's probably outside the scope of what we
Mm-hmm.
want to talk about today.
Yeah, no,
Um,
I appreciate that.
yeah.
The one of the things, and really, as we talk about sellers and this, and obviously there are audits and there are ways that you think about risk, and there are certainly, everyone out there should kind of review where they are, because certainly, one of the main pillars of diligence is risk and AR, right?
Mm-hmm.
There's legal, there's financial, right? But risk and HR, are areas where buyers will dig into, and almost like a good lawyer doesn't ask a question he doesn't already know the answer to. We've seen sellers that say, oh yeah, we answered all your questions on the preparation for risk diligence, but they really didn't have a feel for where the gaps in their plan were. So getting folks to really dive into that is going to be crucial. Do you guys walk people through that? How does that work?
We do, and we try to base it on empirical evidence. And to us, a good source of empirical evidence is events that have actually happened. And so I know we're going to talk a little bit about reps and warranties insurance in a minute, but to my mind, looking at claims under reps and warranties policies is a pretty good way for you to get a sense for the relative likelihood and magnitude of different types of risk events arising out of transactions. And so, for many, many years, I think probably since the very beginning of RWI, which was in the late 90s, early 2000s, financial statements have been the number one source of claims, for a variety of reasons. Things have changed a little bit in more recent years with respect to the rest of the list. So, like data privacy is
Mhm.
now number two. And I should point out that about 1 in 5 reps policies has a claim, which is kind of interesting.
Mhm.
However, keep in mind that, and we'll get into the details of this a little bit later, of that 20%, 20% are with above the retention. so,
Mhm.
so only about 4% of these claims actually result in recovery,
Yeah.
but it still does point out, that claim activity is fairly frequent. Employee benefits is a big vector of claims under RWI, employment matters, environmental, and so on and so forth. But I mean, our view is that if you focus on the things that have in actual reality resulted in claims, and focus on trying to understand the the drivers of exposure, the drivers of risk with respect to those particular areas, you can do a very good job and a very efficient job of, you called it, de-risking your company, in the areas that are, number one, going to matter to a buyer, and number two, matter to a, reps and warranties underwriter.
Mhm. You know what? Let's lean into that, and our audience has gotten a little bit of a primer around the advent of rep and warranty insurance RWI, and maybe you can help bucket it in terms of giving tangible examples, right? And we bang the drum often that 9 out of 10 companies, the acuity in their financial statements and their accounting is nowhere where it needs to be
Mm-hmm.
to satisfy a professional buyer, right?
Right.
An institutional buyer. So while most folks say, "Hey, I trust my accountant and I trust my controller," it's not about trust. It's about accuracy, and it's about every single LOI you see practically has they must be to GAAP standards, and very few
Mm-hmm.
lower middle market companies are to GAAP standards. But talk a little bit, if financial, and let's just put the close of a private equity buyer on because they're making a lot of these claims post acquisition. Maybe give us a couple of examples on the financial side of things where claims have shown themselves relative to either company performance on the income statement or the balance sheet.
Sure. So, as you mentioned, private equity is a very big user of reps and warranties. Probably 80% of private equity deals, are using RWI versus about 2/3 of strategic deals. So, um, slight difference in the take up rate. And if you think about the purpose of of an RWI policy, it basically is a way to facilitate negotiations over a transaction. Um, it fills two functions. Provides coverage for unknown breaches of reps and warranties. Obviously, that's why it exists. But the key point is that it shifts the risk of breach to a third party insurance carrier. And in many cases, that carrier has a much stronger balance sheet than either the buyer or the seller.
Mm-hmm.
And it's usually the seller that obviously you're concerned about their ability to fulfill their indemnity obligations outside of the RWI context. So that's something to consider. Um, the one thing that's happened with claims in recent years, and this is mainly a function of demand, it's a resource constraint issue on the carrier side. Um, More deals than people, essentially. And so, for many, many years, probably from the earliest days, RWI was meant to be very commercial. Deals that move fast, R&I carriers would move fast. Um, Probably this peaked around 2021 when there were just so many deals coming that a lot of these carriers had to say, whoa, time out. But that also applied to claims. And so what's happened now is that some of these claims that used to be um, resolved in a matter of months, in some cases are taking years. So the commerciality has declined a little bit. Now, I will say the market is onto that. I mean, they know that. They know they need to get back to the same pace that their constituents follow. I mean, the private equity firms, even strategics, they're putting in 48-hour days, getting these deals done, doing the due diligence in a short period of time. And they're like, why is it taking me 2 years to get a claim paid?
Mhm.
So that's being worked on. So that's very general. From a specific perspective, there have been a number of cases that have been litigated, and I think those are the ones that are most interesting. And one that I find particularly interesting is called Noble X. I don't know if you guys are familiar with that. Um, it was a financial statement issue. They ended up suing the RWI carrier, it was a big transaction. It was over $2 billion transaction. Um, Noblex was a kitchenware manufacturer, and they um, ran into an issue where and it involved Costco. Interestingly, one of our neighbors here, um, where they listed their 10 largest customers and 10 largest suppliers in the disclosure schedules, and it turned out that there was some misrepresentation with respect to who the buyers and suppliers were, which manifested themselves in $250 million or so in losses that they ended up passing on to the RWI insurers. Um, so this is a good example of the case where the the financial impact was of significant magnitude. I mean, I think $250 million would be judged to be of significant magnitude to just about any company that may be watching this. Um, but it also demonstrates that RWI is not a panacea. In other words, it doesn't cover everything. It can't be broader than with the scope of the representations themselves. And
Mhm.
so it's very important to recognize that whether we're talking about a reps and warranties policy or really any kind of insurance policy, they are all subject to terms and conditions. And while reps policies are very broad, don't get me wrong. I mean, the reps policies have been so well designed, and they clearly were an idea whose time had come in the late 90s or early 2000s. They've only gotten better in just about every way. There are exclusions, um, and it's very important that you work with somebody who's knowledgeable, skilled, experienced in understanding the reps market, understanding the opportunities that reps provide, reps coverage, but also the gaps that you can run into to avoid situations like this Novolex deal where they had this claim denied, and then there was litigation, and they ended up losing at trial. So I think that's a good example of what can happen.
Yeah, and a great takeaway for sellers, right? So the frustration sellers often have when faced with indemnities and reps and warranties, they often feel like, well, how do I know what's going to come out of the woodwork? So how can I say that that is true or to the best of my
hmm
knowledge, right? And really passing on some of that to a third party will protect you from that, right? While you
it
may have a
will.
budget from Costco that they will buy, $10 million
hmm
worth of business from you. It may not come true, and that may be subject to, depending upon how much you've disclosed or how much was
Right.
agreed, how much is verbal versus not. There are some of these things that can come out of the woodwork that can really really affect you, and
Yeah.
that's the purpose of insurance, right, is
Yeah.
to
And another
cover
important
some of it.
consideration with reps and warranties is that it's like another layer of diligence, because part of what you pay for with the process of getting reps coverage is a diligence review by the underwriters. So when you think about the cost of reps and warranties coverage, there's the premium component, and then there's also generally a diligence fee. And so while the buyer is going to be doing their own diligence, it doesn't hurt to have what are mostly M&A attorneys who have become reps and warranties underwriters looking at it as well. And so especially given that they are not covering known breaches of reps and warranties, it's things that are unknown, but try to use their knowledge, skill, and ability, experience to forecast, assertions that are made, representations and warranties that are offered, and how a breach might arise, can be very helpful both to the buyer and the seller as far as lending a little bit more transparency with respect to exactly what the risk profile of the transaction looks like.
Yeah, that's great commentary. I appreciate that. Before we leave the episode here, I want to cover a couple other areas, and since this is somewhat seller centric, Sometimes we let buyers fend for themselves, but hopefully they find some value in our topics here as well. But maybe spend a minute talking about other protections and or things in the market that have taken prominence. As I'm thinking
Yep.
about a seller having tail coverage
Hmm.
for D&O
Yep.
or E&O or cyber coverage,
Yep.
that's classically being diligenced more and more, right? And so what kind of
Yep.
coverages and or tax liability issues can an
Yes.
appropriate kind of risk management solution offer to a seller?
Yes. Let me start by talking about the way we approach it, which is really kind of two areas of focus. The first is with respect to due diligence. And then the second one is respect to insurance products. So, as respects to due diligence, we think that that is a very, very powerful tool. Obviously, I mean, uh, soaks up often an awful lot of resources in the process of evaluating a transaction, and we believe that the work we do, which is focused on risk and then how the company is using tools to address that risk, is very valuable. We generally produce a report in a very short period of time. I think we're faster than just about all of our competitors. I mean, we've done it in as little as 24 or 48 hours in some cases if we need to. Um, and the idea there is that we really want to focus on things that are going to have a material impact on the valuation of the acquisition post close. We want to, shorthand would be avoid surprises and especially avoid
Mm,
negative surprises. So that's one piece of what we do. The other piece of what we do is to try to leverage these insurance tools, some of which you described already, in order to ring fence the exposure and or transfer it to a third party for a fee certain, otherwise known as premium.
mhm,
And so, particularly lines of coverage that are claims made, like directors and officers liability, employment practices liability, fiduciary liability, professional liability, um, and cyber. Very, very important to make sure that you've got continuity of coverage from pre-close to post-close. And you mentioned tail, and for those of you who don't know what tail is, under a claims made policy, as you would imagine, the coverage trigger is a claim is made. However, there is a temporal element to that. So the claim has to be made within a certain time period that's defined by the policy. And in the case of a transaction, you can extend that time period, in many cases up to 6 years, for an additional premium. But it gives you an opportunity to bring a claim for an occurrence or circumstance that took place prior to the close, even though the claim doesn't actually come in until after. And that can be very valuable because if you think about the kinds of exposures that a directors and officers liability policy is intended to cover, or employment practices liability policy is intended to cover, and nowadays, cyber policies are intended to cover, we're talking about potentially millions of dollars at play. Where if you don't structure the tail properly, if you don't bother to execute a tail, you could be giving up contingent capital in the millions of dollars, which obviously that's not productive for anybody. Um, then there are certain exposures like environmental that demand a purpose-built solution, particularly in deals involving land, involving real estate. Environmental due diligence is a huge, huge, huge topic. Simply because two things: one, highly regulated. Well, three things really. It's super expensive to address. Um, and lastly, you can never know for certain. You can do phase two environmental analyses, and you may not find something. However, it may still be there. And unless you have a full and complete history of the uses of that property going back to the beginning of time, you don't know if at one time there was a dry cleaner, an oil refinery, a chemical manufacturer. And it's important to know that. And we've had a number of instances with clients where, in fact, one very large family company in Seattle has owned some property that back in the 1940s was a dry cleaner. And they were asked to be brought into an insurance archaeology exercise to see if somebody could find, if the current owner could find coverage. And we said, there's no upside for you of
yeah,
doing that.
yeah, yeah.
And so they elected not to participate, which I think was the right call. But the nature of environmental exposure is somewhat unique because of the duration of time, the uncertainty,
Mhm.
the difficulty in developing a complete list of all the owners or operators at that facility over the course of the history of time. And so that's one. And then tax liability, in recent years, I'm going to say tax liability is covered to a certain extent under fundamental reps. But unique things like you guys probably remember when if you bought something on the internet in the early days of internet sales, if you were buying it from someone in another state, the presumption was you didn't have to pay sales tax. And that changed pretty quickly when these local governments figured out that they were losing out on millions or billions of dollars in sales tax revenue.
Indeed.
And so for a period of time, there was some uncertainty about whether you owed sales tax or not. And so products were developed in generally the same market as the reps market, to help address that exposure. So if you got a opinion from your CPA or from your tax lawyer that said, based on the law in place at this time, we believe that we've met our obligations with respect to paying sales tax, you would present that to your underwriter, and you could, again, for a fixed premium, you could buy coverage to transfer the risk of potential exposure related to unpaid sales tax that might be tried to, be clawed back by a municipality or a state. And that product is still available. It's sometimes used for NOLs, because you want to be, if you are factoring the value of NOLs into the price of a deal, turns out that you can't actually use them to reduce your future tax liabilities, then there's a financial impact for that you can transfer that. Another area that's emerging is IP, because obviously we live in an era where intellectual property for many organizations is the most valuable asset that they have. And so making sure that, number one, you're not infringing, that no one else is infringing on you, and that the value of that IP is going to be maintained and sustained once it's in the possession of the buyer is very important. And there is a market specifically for IP related coverage as well. So between the tail, the reps coverage, and then the specialty coverages related to transactions like tax liability and IP, the insurance industry has really done I think, a pretty remarkable job of developing a portfolio of products to address the things that really matter. And I'm pretty proud of what we've done as an industry, to tell you the truth. I mean, you look at how the reps market has grown. In the early years, they were selling dozens of policies. Now they're selling thousands of policies a year, and it's about a $2 billion premium market per year. I mean, it's clearly a product that's meeting demand. I mean, the concern is almost that there's too much demand. And we ran into this a little bit a couple of years ago, like I said, where companies that were writing RWI were resource constrained, and they had to walk away from deals, and prices were going up. It's kind of interesting if you look at it from an economic perspective. RWI insurance is very supply and demand driven. As demand goes up, prices go up. And then they get a little bit of equilibrium. And the saving grace really was the last couple of years, the volume of deals has gone down. But during that same period of time, based on what I think I understand, the staffing for these RWI groups at the various carriers have gone up by like 3x. So they are prepared for things to rebound. And I mentioned the commerciality before with respect to claims. It applies to underwriting and pricing, issuing policies as well. I think they definitely get the message that they need to be more commercial. And no one wants to be the one that kills the goose that laid the golden egg. And it really is a fantastic product. It's been profitable, but there's a but. They're trying to write to about a 50% loss ratio. In other words, every dollar premium, they're prepared to spend 50 cents in losses. We're starting to see some bigger deals now where instead of buying reps for like 10 or 20% of enterprise value, they're maybe doing 100%. And on a multi-billion dollar deal, I mean, like on a $10 billion deal, that's a lot of capacity. And, there are, I think, 28 carriers right now that write reps and warranties coverage. You'd probably have to use just about all of them. But if you had a tower claim that hit everybody, how is anybody going to maintain that 50% loss ratio? So it's a concern I have. I'm not going to say it's insurmountable, because it's not. Good underwriting, good diligence can address a lot of these concerns. I don't foresee any significant increases in pricing. In fact, pricing has come down since 2021 as the demand has slowed, as the number of deals coming down has dropped. Um, but everyone wants to preserve what's good about a product, and I think that's true of the reps market as well as anyone that's writing transaction insurance. I mean, we want to maintain our value. We want to maintain our relevance, and we know to do that we've got to be commercial, and so we try our damnedest to continue to do that, both on the diligence side as well as on the transaction insurance side.
Yeah, that's well said. And I think our audience, from their perspective, from a seller's perspective, I think one thing in particular, that they'll probably take away from this episode is that you need other folks around you that can advise you and work on some of these critical issues, even if you don't necessarily understand them. Bringing experts like Seth to the table
Mm-hmm.
to really advocate on your behalf, to audit your risk, and to help you navigate what is, risk and what that means to you is really helpful. And Seth, I want to thank you for joining us on the Middle Market Moment. And maybe just to wrap it up, let us know how folks can get in touch with you. What's the best way?
Sure. So thank you. And I will say that it's very important to recognize that if you can develop a distinctive competency in managing risk, it can do two things for you. Obviously, make you more competitive, but also increase the value of your enterprise. And we are passionate about helping our clients do that. If you want to reach me, I'll give you, maybe this is dangerous, but I'll give you my phone number and my email address. My phone number is 206 577 6872. And my email address is seth.shapiro, basically my first and last name with a dot in between, at usi.com. And I'm always there to answer emails or answer the phone. So please feel free to reach out.
Awesome, Seth. Thank you so much. And thanks to everyone listening. And good luck on your journey to the deal of a lifetime.